Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's go to Poonam Goyal. She's a Bloomberg Intelligence senior U.S. retail analyst. She covers all this stuff. Poonam, what's going on at Nike? That's still my brand. I mean, aren't they still the dominant player here? What's going on?
I'm going to say you're not the target audience.
You don't
anymore.
think I'm the target demo? I mean,
just
I'm not the target demo for like anybody anymore. All right, Poonam, what's going on at Nike?
So, Paul, Nike definitely is still the largest athleisure brand in the world with over $50 billion in sales. But in the last few years, it has lost a share to Hoka, to On, and even to Adidas, if you want to say. And part of that is because it pulled out of wholesale. It pulled out of where people shop. And also it focused a little too much on the digital space, giving product really little focus. And that's why we're seeing a change today. We need someone who can come back, go back to the Nike DNA, and really focus on product performance to deliver what Nike has delivered for the last 30 plus years.
When you say they pulled out of retail, what do you mean? They tried to sell it themselves online and their website?
Well, it's not that they pulled out of all retail, but they definitely curbed their exposure into retail, whether it was through Foot Locker, Macy's, etc. They had materially pulled back what they were selling into those stores, and now they're back in. So they did come back. But what happened is if you went to a Foot Locker prior to 2020, 2019, 2018, you'd see a lot of Nike there, right? Nike was the predominant brand. And had you walked in yesterday even, what you'll see is Nike. You'll see Adidas, you'll see Hoka, you'll see On. So now people are being exposed to more brands, and that's part of the reason. But also those brands are good brands, right? They have performance. Hoka for running, On for running, for lifestyle. They've really gained traction, and that's because Nike let them.
I guess it was a week or so ago, we had Derek Jeter in here with the founder of Untuckit, Chris Riccobano, and they were talking about they're introducing a new brand of performance athletic leisure. And I heard their story, I heard their pitch, but I'm like,
what in the hell does that mean?
There's so much competition in there. How competitive is that market, athleisure? I mean, nobody's wearing the suits anymore, Poonam. That thing's gone. So I guess everybody's kind of into athleisure. How competitive is that part?
So it's very competitive, but Nike's still the dominant player at $50 billion plus in sales. It is definitely winning in the shoe category. In apparel, I'd say the gap is much narrower to other players, including Adidas and others. But it's also a space that's growing, right? So as we hear more competition encroaching on the space, it's because more people want more athleisure in their wardrobe. So I'd say it's a category where it's not necessary that one has to lose for another to win. The category itself is growing globally.
How long does it take to bring a new product, sneaker, whatever, to market?
It takes more than 6 months, depending on whether it's just another color wave or depending on if it's a new performance-based product. But the pipeline is long. And remember, most of these sneakers are made in Vietnam. Vietnam is the sneaker hub for manufacturing sneakers. Therefore, there is a transit time involved as well. Now, you can argue that AI is going to cut some of that because the design can happen faster and you can pre-secure fabrics, etc. But still, it's still a long window.
The CEO who's getting canned, I don't know, who's outgoing.
John Donahoe.
Was he a bean counter? I mean, what was the problem with this guy?
It's not that there was a problem. He was not a merchant. So John Donahoe came in with DTC exposure. So he is the one who led the digital first strategy, wanting to lean more into digital. And while that's great, it is great to lean forward into digital. But at the end of the day, retail is about product, especially when it comes to a brand. Nike is not a marketplace. It's not Amazon. So product matters most. And he just didn't have that product expertise behind him.
John, you and I know the fellow who runs this place, but if I were running this place, here's how we go. No shorts in the workplace and no sandals. That is Did
you know, Poonam, that Paul is the fashion police here at Bloomberg World Headquarters? and he's driving everybody
Absolutely.
crazy.
He's always in Short Hills malls for us, right? Checking out the stores.
I am. I do some channel checks for Poonam in the Short Hills Mall. All right, Poonam, thanks so much for joining us. Appreciate it. Poonam Goyal, she covers all the retail stuff for Bloomberg Intelligence. She was Bloomberg Intelligence just celebrated its 15th year anniversary. She was my first hire here, and I've hired 330 analysts, and she was number one. So that was a good one for us.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, what do you do here? The Fed cuts rates. You're a financial advisor. What do you do with your clients? What do you tell your clients in a world where finally rates are coming down? Let's check in with somebody who does that stuff for a living. Sarah Ponczek, financial advisor for UBS Private Wealth Management. Full disclosure, I am a client of UBS Private Wealth Management here in New York. They take care of me. She's down in Boca Raton, Florida. That's not a bad place to be. Sarah, thanks so much for joining us here. All right, the Fed cuts rates. What kind of phone calls were you fielding from your clients after that news, which was, for some people, a surprise?
Yeah, it's great to be with you, Paul and John. It didn't really come as a surprise, I would say. We've all been talking about this since last year, it feels, but finally the first rate cut since 2020, and the Fed came out swinging with a 50 basis point rate cut. So the conversations that we've been having with clients, even though it should not have come as a surprise, we've been talking all year long about locking in interest rates, extending out duration, slowly moving out of high yield savings accounts and money markets with cash that you do have. It's been difficult for some people to do that. So finally this week, now that we actually saw the 50 basis point cut, the question is, okay, am I too late? If I still have a lot of money in cash, what do I do with that cash? So those are the types of conversations that we've been having this week, Paul.
So, Sarah, what do I do with my cash, Sarah?
Great question, John. So, what's interesting is, yes, we're continually and repeatedly saying, all right, if you haven't already locked in yields through fixed income and extended duration, now's the time to do so. And what's interesting is sometimes we do get pushback. There's this gap or this misunderstanding where someone might say, well, why would I lock in, a 3, a 5, a 10-year bond that's yielding 4 or 5% when my money market is still yielding, 4.8 or 5%? There's this trade-off that some people feel as though they're making in the short term. And what you really need to be aware of is the fact that, yes, your money market might still be paying you, close to 5% today. But if you look at the expectations of where, short-term interest rates are going to be a year from now, at the end of 2025, we're looking at short-term yields being close to 3% most likely. So if you can lock in a 4% treasury bill, years out into the future, yeah, you might have a trade-off for the next couple of months, but you're going to set yourself up for success over a longer period of time, which is really the name of the game. So that's on the fixed income side. Extending out duration, we're talking about, maybe 3 to 7 years in maturity, looking at that intermediate duration in the curve, and also staying up in quality. So looking at treasuries, also looking at investment grade corporates. Now, on the equity side, we still believe that the risk reward for equities is pretty strong here. And yes, we've seen a 20% return in the S&P 500 this year. Stocks are trading at records. That's great. But we're seeing this broadening out. If you look at an equal weighted version of the S&P 500, it also traded at a record high yesterday. If you look at the sector breakdown of the S&P 500, all but 2 sectors are trading at 52-week highs. So we've seen this broadening in the stock market, and that's really encouraging as an investor.
Sarah, ETFs, how do you position them for your clients? How much incoming calls do you get from your clients about ETFs?
Great question, Paul. Obviously we can talk about investing and where to invest, but then there's a question of structure and how you invest. What products do you use to invest your money? So I would say, we do use ETFs in portfolios, but we use them in more so in a supplementary way. When we think about the core portion of our clients' equity portfolios, a lot of what we do is actually what's called direct indexing, which we would describe as being a step above ETFs. It's like as an investor, you have your own index that's catered to you. And why is that important? There's a couple of things that you can do with the direct index that you cannot do with an ETF. When you have an ETF, let's say an S&P 500 ETF, that's one line item in your portfolio. So if the market's up, your ETF's up in value, there's not much tax planning you can do there. You really can't do tax loss harvesting, which, especially as we're getting towards the end of the year, this is the time of year that we're going to start seeing tax planning really come to the forefront of portfolios. So within a direct index, you actually own a couple hundred positions within the portfolio. We all know that even in a year in which the broader stock market is up, there's a lot of individual stocks that trade at losses and pretty hefty losses throughout the year. So what that allows you to do is continue to get market performance in your portfolio, but do plenty of tax planning on the bottom side. And really what a lot of research has shown is that can add, an extra 2% of performance per year on an after-tax basis. So usually for US large cap stocks, we're pretty big believers in passive indexing there. We'll use direct indexing, and then we'll use ETFs to supplement that. So that's where we, right now, for example, small caps might perform pretty well with the expectation of interest rates coming down. So adding to small caps, adding to size exposure there, diversifying internationally there, maybe adding a little bit of international exposure, and then also playing industries and sector tilts. We've had some exposure to some ETFs that really more so focus on artificial intelligence and cybersecurity this year, for example. So using ETFs as a supplementary play to, say, your large cap core indexed portfolio.
Okay, so if with risk assets, Sarah, it's as easy as just finding stocks that do well in a lower rate environment, i.e. tech?
So, yes, look, I think there's a couple of reasons that we're still very
I'm not saying your job isn't
tech.
hard, Sarah.
It's very, I would say it's pretty difficult, and you're dealing with a lot of interesting personalities sometimes who are
and you're in Boca, which all the
There's
retirees, right? Those are your clients.
All the retirees, but it's been raining a lot here. So I honestly envy you up in New York right now. But we're about to get to the nice time to be in Florida. But no, I think what's interesting about tech is it's not just an interest rate play. Look, tech has been the leading sector and the leading industry for the past couple of years when interest rates were high. Nowadays tech is quality. Tech is also, mega cap tech is a play on the artificial intelligence trade and growth that we expect to see. And yes, growth is an area of the market that's interest rate sensitive, because essentially at the end of the day, when you look at tech, we have to think about the net present value of future earnings. And the lower interest rates are, the more attractive that future stream of earnings looks. So yes, we've been optimistic on tech in the past, and that wasn't an interest rate reason. And now I would say interest rates coming down is even more so a reason to become optimistic on tech. With that said, though, you don't want tech to make up your whole portfolio. Yes, we do think it makes up a very significant portion of a portfolio. But I mentioned earlier on, we're seeing a broadening out in the market. We're seeing some cyclical sectors of the market, start to play catch up. So you want to make sure that you're well diversified, but absolutely tech has been a predominant role player in portfolios for the past few years, and we really don't see that changing.
Sarah, to what extent do your clients ask you about getting exposure to alternative investments, whether it's hedge funds or private equity, private credit? How does that play?
So it's becoming more of a common theme. I would say it's still a conversation that we're bringing up rather than a lot of clients coming to us and asking about it, because alternatives are so important. When we think about the universe of public companies, think about the universe of companies nowadays that go through an IPO to list on a public stock exchange. I mean, it's a very different world than it was, 10 years ago, 20 years ago. Fewer companies are going public nowadays, and many of the largest companies in our global economy, especially in the US economy, are actually still private companies. They haven't gone public. So now more than ever, it's important to get exposure to private markets, because it's a whole area, a whole universe of the economy that you just don't have exposure to in your portfolio if you don't have exposure to private markets. So where within private markets, do we look? We do still like private credit. Private credit has been paying an annualized distribution yield of around 10%. Yes, a lot of these loans are floating rate, so we are going to start to see that come down, but we still see that as an attractive place to be, especially as an alternative to just traditional fixed income. Also, private equity. Private equity is, we see as a very important piece of portfolios. Talk about lowering volatility. You don't have the day-to-day swings of what you see on public stock exchanges, but still getting those strong double-digit returns in private equity. And what's also been really interesting in the private equity space is we've seen more, investor-friendly structures where you're not locked up for 7 to 10 years. You're not dealing with capital calls. There's these evergreen structures that have been produced where you can actually get out on a quarterly basis. You have more liquidity. So the environment for privates, I would say, has become much more investor-friendly over the past year or 2 years even.
Speaking of volatility, have you seen the volumes today? Triple
Yes.
witching day. Oh, real quick, Sarah, just a minute. How do you use volatility to your advantage as an investor for your clients?
Absolutely. So especially, look, we've seen some volatility over the past couple of months in a year in which volatility really hasn't existed. So look, on the equity side, if you're someone who sells a business, if you are sitting on a hoard of cash, no, you have emotional ties to the money. You don't want to invest it all at once. So use volatility to your advantage. Yes, have a set plan. You want to slowly dollar cost average into the market. But if you have a week or a day in which you see more volatility, maybe you speed that dollar cost averaging up. Maybe you pull your investments forwards and you use those down days to slowly get yourself invested.
Right.
Because at the end of the day, the longer you're sitting on the sidelines, the longer it is to get in.
All right, Sarah, thank you so much. We always appreciate getting a few minutes of your time from South Florida. Sarah Ponczek, financial advisor, UBS Private Wealth Management here. Again, investing in a world where for the first time in a little bit more than 4 years, we actually have rates coming down. For a lot of folks, that's kind of a new environment to invest in.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
How about this ready mixed drink things? You see, like vodka and iced tea. You see the little banners going
I have my
across?
favorite.
What is that?
It is a Mai Tai, and it's just like out of this world. Curzon top shelf liquor. I can't remember who makes it, but it is out of this world. And you can only have one, because more than that, you're in a coma.
Really? I mean, that's what the kids are doing these days. I don't know what's going on out there.
Not that I'm a
so-
kid, but
I'll tell you somebody who knows this stuff. He knows his booze. He knows his weed. That is Ken Shea, Senior Consumer Products Analyst.
that's some
for
intro,
Bloomberg
Ken.
Intelligence. Yeah, hopefully his kids aren't listening.
And he's sitting upright.
He's sitting upright, but he's been covering all these beverage companies, and he's seen every fad come and go. Ken, what's the latest kind of strategy there for, the Coca-Colas of the world, the Pepsis? Where do they see growth these days in new products?
Yeah, hi guys. So for Coca-Cola, they bill themselves as a total beverage company. That's their aspiration. They want to be in all beverages. Having said that, it's also a company that is very image and reputational conscious. So it's moving at a very measured pace to get into the $2 trillion global alcoholic beverage space. So they're doing so by partnerships and alliances. So you just heard the other day they entered into a partnership with Bacardi, the big rum company, to make Bacardi and Coke, a product that we all kind of know.
I see what you're doing. Okay.
And so it's a ready to drink. It saves people time, that kind of thing. They've entered similar kind of arrangements with Brown-Forman, with Jack and Coke, Jack Daniels and Coke.
How lazy do you have to be to not be able to figure out you can pour one and pour the other? Pre-mixed.
You have a point there, John. But think about if you want to go to the beach, right? If you want to go somewhere to have a picnic, you don't want to carry all these bottles around and worry about ice and whatever. So it's a convenience, and consumers are willing to pay for that convenience.
All right, explain to me, Ken, because this is not John Tucker's demo. White Claw. What is this stuff? Why are all the kids drinking it down the Jersey Shore?
Well, White Claw, it's produced by E&J Gallo. They know the wine market really well.
Yeah,
they know their demographics well. They sensed that there was an opportunity for a arguably a better tasting, more modern version of a low alcohol refresher. And they've really hit a home run with that product. I think it was really a game changer in the whole hard seltzer area, and it's still a very strong, entrant. That said, and not to go off topic too much, but the trend now is to have vodka-based drinks. So high noon vodka and tequila-based and vodka-based high noons are all the rage right now.
Oh, and what about hard Mountain Dew from PepsiCo?
That's not faring quite as well, but there's a niche market for these types of products. I mean, this is 5 or 6% alcohol by volume. So you see a hard product. Most of these are malt based. They're about the same alcohol level as beer, but it's for someone who may be tiring of beer. The beer, taste is giving way to things that are a little more flavorful. I think some of our data from our surveys bear out that consumers are looking for something new and exciting, and looking for new flavor experiences beyond beer. And so there's a niche there for that.
Brings me back to my college trip with my buddies to Paris. We're in the hotel room. All we had were little vodka bottles. I was like, well, we're not going to drink vodka straight. What can we get? So we went down to the soda machine. It was about midnight. And what they had was Fanta orange soda.
Nice.
You can mix those two. There's my idea.
There, John Tucker, thank you. All you need from me is a glass, ice, and Tito's, and we're good to go. All right, so let's switch gears. Let's go to the weed business. Ken, give us the update on just kind of the development of that business here in the U.S.
Well, in the U.S., as you know, it's still federally illegal, prohibited. So the revenue growth for cannabis in the U.S. is really state by state. And so all eyes right now are on November 5th. Florida, the referendum to legalize is on the ballot.
Oh.
You need 60% of the vote. All the polls that I've seen strongly imply it's going to pass. Think about Florida, the third largest state in the country, 100 million visitors annually, could be open for business for legal marijuana. So all eyes are on that market right now.
All right, well, here's my experience with it, and I shop for a friend, not for me. Is the dispensary in Neptune, New Jersey, is quite the nice experience, by the way. I tell you, the weed bartenders are the friendliest, most knowledgeable people I've ever dealt with.
Because they're all high.
I guess, but I mean, it's actually a good experience. So what's it been like in New Jersey, Ken, the cannabis business?
Oh, it's booming. Absolutely, it's absolutely booming. More and more are cropping up across the state, and it's been a big success so far. And
I'll tell you what. Go ahead.
No, I was going to say, but it's also inviting competition. New York legalized shortly thereafter. Now Pennsylvania is looking to do so. So other states are watching closely also.
I can tell you, in New York City, they used to have all these random kind of.
Well, they cracked down.
They cracked down
gone.
Big time. They are all gone, literally in a blink of an eye. And now there's only just a handful of ones that are approved, and there's one like on my walk to Penn Station. I see it there, but there's not many. It was out of hand there for a while, but they cracked down. All right, Ken Shea, he is our guy. All things booze and weed. He's a senior consumer products analyst. He covers everything, folks, from Coca-Cola to the cannabis business to everything. And it is a huge, huge business, huge companies, huge free cash flow. Nice dividend yields, too, for folks looking for dividend yields. Those consumer products companies have always been a place to hide and kind of a little bit recession-proof, by and large, for those names.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, we got a Fed that's cutting interest rates. We just came out of a really pretty strong second quarter earnings season. Expectations are for some pretty decent earnings coming up this quarter. That seems pretty constructive to me. Let's check in with somebody who gets paid to do this stuff. James Abate, he's Managing Director and Chief Investment Officer at Center Asset Management in New York City. James, thanks so much for joining us here. Did the Fed move yesterday? Did that change, or Wednesday, did that change your outlook at all here?
It's too early to tell. Really, if you look at what the Fed did yesterday, and frankly, if you read the headlines about yesterday's stock market reaction, the Fed talking about the fact that they're taking out an insurance policy so as not to risk a recession. It's almost, verbatim to what the newspaper headlines and the commentary read, way back on, January of 2001, when the Fed, similarly surprised with a 50 basis point cut in the Fed funds rate. Obviously, no parallels exactly the same, even if it rhymes. But, clearly there's this very big dichotomy at this stage between economic data, which the Fed is relying upon, versus what we're seeing in terms of expectations for corporate profits.
Okay, the Fed, as you put it, is taking out an insurance policy. Should I be investing in some sort of insurance in a portfolio as an investor?
Yes, you should. Absolutely. I think, from our take, we think global economic growth stays like in this low gear. We're not in a technical recession, but we're very much vulnerable to a demand shock in the United States, much like the economy was, I hate to say it, back in 2001 prior to 9/11. So, from our perspective, the winners are going to be, treasuries, defensive growth stocks, infrastructure, utility stocks. The key for us is going to be if companies can somehow, maintain the very lofty earnings expectations that are embedded in stock prices today and not disappoint like Federal Express did today. And if the Fed can somehow, move policy rates towards what 2-year note is, that is, down toward about 4%, which would equate to about a 2% real yield, 2% inflation. I'll be the first person to vote that they rename the Eccles building down in D.C. for Chairman Powell.
So, James, what are some of the sectors, I guess, that screen well for you? And how do you select equities, generally speaking, and what's looking good these days?
Yeah, that's the thing. I mean, we're pure bottom-up investors, and we always try to reconcile what's going on bottoms up to the top-down information. And, the story that I talk about today is, if Rip Van Winkle was asleep, right, and he woke up and you only showed him top-down economic data, you'd look at U6 unemployment, moving sharply higher, trucking, construction, steel production softening, ISM manufacturing and contraction, inverted yield curves, collapse in global commodity prices except gold, China, European economic stress getting worse. And you saw, anecdotally, new car registrations in Europe down 18% year over year in August, disastrous profit warning from Mercedes-Benz, auto and credit card delinquency spiking higher. Rip Van Winkle would say we're already in a recession, if not, moving into a shallow one. But, if you showed Rip, price charts of the S&P 500 and concerning consensus earnings expectations, he'd see a PE of 22, margins, at all-time highs and, a standard deviation above 20-year averages, and sell side expectations of 6% top line growth and 15% earnings growth for 2025. So Rip would say that we're on the cusp of a boom in profit growth without having ever entered a recession. We're more leaning from a bottoms up perspective towards what the economic data is saying, which is back to the point of defensive equities, the fact that treasuries will probably outperform credit and maybe even equities at this point in time, and a cautious stance towards profits. And I think this earnings season coming up is probably going to be the most important season that will dictate the future direction of what stock prices will do for the next 6 months to 12 months, more so than what the Fed does, more so than what the presidential election results are.
Broadly, what's your allocation right now in a percentage? Break it down that way.
Well, if you look at, we run one dedicated infrastructure fund, which is actually having a spectacular year because we're recognizing that, utilities have gone from being bond proxies to, in essence, growth proxies with the power generation needs of AI and other things. But in our American Select Equity strategy, we've introduced long duration treasury bonds. That's the first time I've done that in an equity portfolio since early 2000. So maybe that tells you something. When you look at our sector overweights within our American Select, our biggest overweights are in consumer staples, healthcare, and we're dramatically underweight all cyclicals, but we do have some exposure within the Magnificent Seven because you continue to see those stocks being, very driven by the fundamental momentum towards this AI craze, and we're not sure when that is actually going to end. And these companies are demonstrating some degree of excellence.
All right, James, thanks so much for joining us. Always appreciate getting a few minutes of your time. James Abate, he's a managing director, the chief investment officer at Center Asset Management, located in Lower Manhattan here.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.